Hey, what's going on everybody? Jeff Beers here, 40 Finance channel. Today I'm going to look over my picks for the best stocks to buy in 2020. I've got my little precursor here though. We have to wait till after a dip. Things are a little hot and heavy in the market here in January. But these are my picks for the most likely stocks to get you a return on your investment over the long term, starting here in January 2020. They also have an element of safety and lower risk to them, which I think make them pretty attractive to everyday investors. Okay, first on my choice of best stocks to buy in 2020 is the company Visa, ticker symbol V. Visa is just a revenue generating machine, and if you're not super familiar with Visa, they do not have anything to do with extending credit to customers. So when you get your Visa card, obviously you have a credit line, and credit cards can be risky because people don't pay their debts and interest rates and all those things. That has nothing to do with what Visa as the company does. They are just in charge of the payment management side. So credit card fees, distributing money between banks and merchants, that's where their game is. It is a steady race, particularly in the game of online commerce where credit card transactions are the norm. So Visa's long-term prospects are very good. It is a safer place to play the world of finance and payments. And right now, if you take a look at this stock, right now the PE ratio is 37.93. The 4P drops to 32.26, so it is a little bit higher from a cost perspective, but that is really just because of the market conditions currently. All these stocks that we have today, they're all going to be up a little bit in their PE ratios, and that's just because things have run so high. But you take a look at this one-year chart, and you can see that 1 year ago at this time, we were below $150 for Visa. It's actually crept all the way up to 200, but that's just a slow and steady incremental improvement as earnings per share continue to go up. It's a great company. I like it a lot. Let's take a look at their performance from the past 3 or 4 years. Okay, so for this, and these numbers might be a little small on the screen, but the bottom line here is this is about a 5-year chart of valuation measures for Visa stock. And if we go back to 2013, this stock had a market cap of $121 billion, which is a great starting point, and now we're up to $448 billion. So you're talking about, roughly 4 times growth since 2013 in market cap. From a PE perspective, we are kind of at the higher end of what we've seen in the past 5 years. So the 37.91 PE ratio that we have today, back in 2013, that was sitting at 23. Forward PE back then was 21. Forward PE today is 32. So what you're really seeing on some of this stuff is over the past couple years, the cost of buying Visa has gone up, but the performance has continued. So when I say in the beginning with 2020 stocks to buy after the dip, this would be a good one because I think inherently, there's risks of coronavirus and everything else. I think eventually we're just going to have a pullback of some kind, and I would try to get somewhere in the neighborhood of a 5 to 10% beat on the price. All that being said, this isn't only a growth stock in terms of share value. You also get a very small dividend of 0.59%. I anticipate that as Visa grows, they will continue to increase their dividend over time. So even in a down market, you get a little bit of a return with the 0.59%. All right, so next up on our list today is Microsoft. And Microsoft, continues to be a real strong stable of the technology investing realm. Their performance now has hit a place where a lot of people didn't think they would be 25 years from now. They got the new CEO in, and he has really changed the company, turned it into cloud provider, subscription business model. Those things have really added up very, very well over the past 3 or 4 years. And I think what you're going to see with Microsoft going forward is they're printing money. Okay, that's what all these companies on this list today are doing. They're literally printing money, and they still have opportunities for growth. So the cloud computing is one opportunity for growth for Microsoft. They're already a market leader, but as that industry matures, there's going to be a lot of contracts switching hands, and Microsoft is a name that people trust, and in a lot of companies you're already using some of their other software and capabilities for your workers. So bringing on a Microsoft cloud system, for example, might actually be streamlining for a company, which I think will help them secure more and more contracts across corporate cloud infrastructure. Okay, on the stock side of things, current PE ratio of 30.62, forward PE drops ever so slightly to 30.49, and Microsoft also offers a dividend. So again, you're seeing great increase in share price over time, particularly for a company so big, but you also get a 1.24% dividend mixed in as well. So even in a down market, you are going to get some cash back in your account with a company like Microsoft. Here's a look at the 5-year chart performance of Microsoft. In 2013, they started with a market cap of $288 billion, and they have since turned that into a market cap of $1.27 trillion. Okay, so just about a 6x on that, which is unbelievable, going from $300 billion to $1.2 trillion. From a PE perspective, again, these stocks were cheaper 5 years ago. Microsoft had a PE of 17.81. That's now up to 31.35. And forward PE way back when was only 11, which is unbelievable, and it's marched up to 30.49. Both of the current PEs are the highest levels that we've seen in the past 5 years. So I think once again, the sort of after the dip perspective, we need to try to cut 10% off somewhere in the price, hopefully with a market event. So I think Microsoft is a safe play, but you're trying to poke in on little dips, right? You're not trying to put all your money into the basket at one time. You're looking across 12, 24, 36 months where you can come in and sort of get your average share price down a little bit. Microsoft's going to continue making money. It just depends on the ebbs and flows of the stock market, which will determine how much money you make in comparison. Okay, number 3 on the list, it might be considered the riskiest of all these stocks, but I believe in it very strongly. Home Depot, okay, ticker symbol HD. Home Depot, of course, is the large chain of gigantic hardware stores, competes against Lowe's, Menards, some of those places. And what I really like about Home Depot is just the nature of their business and the fact that, home projects, real estate investing, home building, anything that you can imagine in that world is not going, A, it's not going away, and B, it's going to be growing. You don't need to have an increase in home building contracts for Home Depot to do well. Okay, in this current environment with low interest rates, you're talking about a ton of people who are renovating their homes. They're doing new kitchens, bathrooms, things like that, decks, landscaping, all those things add up to money for Home Depot, and they have really done a good job in 2 areas over the past, call it 3 or 4 years. One would be serving smaller contractors with friendly terms and credit situations. So you're getting in, John's renovation company, maybe he has 2 or 3 trucks out on the road, but you're setting up contractor deals with him so that he buys all of his supplies products from Home Depot, and they've made it very friendly for contractors to book these orders, not only online, but so that when they get to the store, in some cases the stuff's already ready for them, and they have a credit situation so that they can finish the job and then pay Home Depot, which is good news, especially if you're in a small business. The other thing that Home Depot's done, which I think is outstanding, is they've really raised the bar on their e-commerce. So traditionally, hardware stores, I don't know how much people thought of them as e-commerce plays because the needs were so specific for the buyers, right? So you wanted a door handle or a key or something like that. It doesn't translate super well to e-commerce because you feel like you need to see it and hold it. But the way they set stuff up, particularly with the sort of reserve at store or check inventory at store, can save even the average consumer a lot of time and headache. So that's one of the reasons that Home Depot continues to win, is just innovation from a sales side. Looking at the stock today, you got a PE ratio of 23.02. The forward PE drops just a little bit to 22.45. That is, a fair price. We're talking about a retail store, so it's not uncommon, to see, like, say Microsoft was in the 30s, you look at Home Depot PE in the 20s. That's really just because retail stores bring about much more risk, so the expected PE for retail store is right around this level. But you also get the dividend, and it's a very healthy dividend with Home Depot, 2.34%. So it's a really good added bonus for your time. All right, looking at valuation metrics from the past 5 years. Back in 2013, Home Depot was $100 billion company. They have since grown incrementally up to $254 billion in market cap. So, not as strong as a ride as some of the technology companies, but when we're talking about retail, and we all know what's happened in retail, for Home Depot to have this type of growth is very encouraging, in my opinion, for the future. PE levels have stayed about the same for Home Depot over this 5-year stretch. Back in 2013, we were at 23 on the trailing PE, and the forward PE was 18 back then, and then today we're up to 22. So the cost of a share from an earnings standpoint or a profit standpoint has been relatively consistent in this stretch. So I think the big thing that you can look for with Home Depot, if you're trying to save some money on the share price, usually world events are going to be the one that gets it. Whenever there's a hurricane or something like that close to the United States, Home Depot generally goes up, just because they know, depending on how big the market is that the hurricane's hitting, it usually ends up in a revenue boost for Home Depot for that quarter. However, when things, like the current environment, when the stock market just sort of crashes a little bit to correct itself, those are going to be great times to get into Home Depot, because you're literally, unfortunately, you're literally a natural disaster away from bumping that stock right back up. So you can have quick returns on Home Depot. You just have to sort of weather the storm, if you will. All right, last one on my best stocks to buy in 2020 after the dip is McDonald's. So McDonald's, fantastic stock. Decades of success, decades of making money for people. Some folks hear McDonald's and they think that this is a company that's probably out of tune with the real world because of the health food craze and all this. Couldn't be further from the truth. And the fact is, in America and internationally, people choose McDonald's for a wide range of reasons, including some of their health options. But most importantly, right, quickness, convenience, low prices. It's a simple formula. It works across anything consumer. So that's why McDonald's is on this list. Right now, their stock has a PE ratio of 27.48. The forward PE drops just a couple points to 25.19. And it does have the biggest dividend on this group of 2.37%. So McDonald's is a fantastic long-term stock that will almost undoubtedly grow as they continue to build. If there's risk with McDonald's, it's usually a couple things, okay? There can be health risks with a company that is serving so much food. So it only takes, one batch of bad lettuce or whatnot to kind of send the stock down. Food companies in particular, you could have some weird report or some sort of social media boycott that could, impact McDonald's to an extent. I think that theirs is so big, their pipeline of restaurants and perception is so gigantic, they'd be less likely to have that sort of social media attack. But I think the health risks are real. And as we've seen with this coronavirus, it only takes something like that to spook everyone, and they all stay in their house, understandably, so that they don't spread sickness. And that can obviously put a dent in any company, but particularly a restaurant. Looking at the last 5 years of valuation metrics for McDonald's, here's a company in 2012 that was at $88 billion. They've almost doubled that in the past 5 years from a market cap perspective. They're up to $159 billion. The PEs in that stretch, back in 2012, the trailing PEs started around the 16 range. We're up to 27. Again, I sort of attribute that to market conditions. Forward PE back in the day was close to 15. Now we're up to 25. So like all these other top performers, the cost of acquiring a share has definitely went up for the retail investor. The best way, of course, to counter that is to recognize that this share price right now here on January is more expensive than we've seen from a historical perspective. So maybe I, as an investor, will wait for the right opportunity to get a discount on current prices. That's all it means. It doesn't mean that McDonald's is an expensive company that you shouldn't buy. I would just argue that right now, through its history, it's running a little bit higher than it has been, but it's a great stock to put on your list of, a wish list, right? What am I going to do when the market does go down? Hopefully you're putting money in a savings account, or you're dollar cost averaging and you're buying stocks, 5, 10, 20 shares at a time. And then throughout the year, your average sale price or your average purchase price will go down as long as you're paying attention to the news every day. That's the best way to attack not only the McDonald's stock, but all the other stocks that we've talked about here today. All right, guys, so there you have it. Those are my picks for 2020 best stocks to buy after the dip. Wait for a little bit, try to get a 10%, 5-10% price reduction in the market. I think it will happen, but these 4 stocks here today are definitely long-term winners, and it would take an unexpected event to affect their earnings history and earnings future, because they've already proven time and time again that they know how to run a business. Hope you guys enjoyed this. Please give me a like and subscribe if you can. See you on the next video.